So your journal for payroll, you're going to have to debit your payroll expense and credit your payroll liabilities. Okay, remember those expenses could be your pension, medical aid, and then a relevant payroll liability for that would have to be raised because that will need to be paid over to the pension or medical aid. Other than that, the payroll expense being your salary or the wage, and then the liability to make payment for that salary or wage, as well as your PAYE and a liability for that. So what does IAS 19 say in terms of this? You need to recognize the expense when the entity consumes the economic benefit. So as the work is being done, you're going to have to recognize the payroll expenditure for that. And the liability when the employee has provided the service in exchange for those benefits. Okay, so that's it from an IAS 19 perspective, guys. Other kind of things that could be affected in the payroll, things like your share-based payments, recognizing that expense and then the liability that goes with that. Okay, that's something that potentially would only be at a level 2 level, and you'll see we'll follow the exact same process no matter what in terms of that. What IFRS says about this is that you're expected to realize these liabilities within 12 months, so you don't need to raise them at a discounted amount because they're current. Alright, so the risks here for the expense or for the transaction, we got our same risks, that it's not recorded on the incorrect date, or that it is recorded on the incorrect date, or incorrect amount, or incorrect account, or risks and rewards haven't transferred. So it shouldn't be recorded. And that's also not dealing with the actual journal that has been raised. But potentially they don't raise a journal, and they should have, so then you've got the risk that they haven't recorded. But they should have recorded it. Okay, because obviously we have date, description, and amount here when recording a journal. The opposite side of this, once this has been raised, is to make the payment, so debit the liability and credit bank. So what are the documents that help us here? Well, with our expenses, it's going to be those contracts. For our salary, for our wage, it's going to be contracts plus clock cards to show the hours. And the payment here, there would be some sort of EFT or check to show it, and again, the bank statement. Okay, so that's going to be your transaction, and in terms of the balance, which would be the liability at your end, I don't really expect any subsequent measurement because of the fact that they've said that there is, or it should not be discounted because it should be realized within 12 months. So ultimately, the only effect that we should have on the liability is the payment. So the reduction once payment has actually been made. So recognize that it's transaction price, so based on what the actual transaction is recorded in terms of what's in the contracts or hours on the clock cards. There's no subsequent measurement because it should be realized within 12 months. Again, it's a liability, so we don't have the reduction of the liability to be prudent in terms of the accounting framework, you have to record a liability at the amount owed, which differs very much from an asset, where you would need to reduce it to be prudent, to show what you can get for that specific asset. Your disclosure, in terms of your IFRS requirements, you've got to obviously disclose all the details with regards to all your expenses and so on, your payroll expenses, your directors' disclosures in terms of the Companies Act, directors' remuneration, and then in terms of IAS 19, we've just got to have all our employees' info, employee costs info. That needs to be disclosed. Guys, you don't, again, when I said to you earlier about disclosure, you won't have to go into detail of disclosure other than as a substantive procedure, making sure you have considered that they have disclosed it correctly. When we get to the actual procedures, you'll see that. But just to note that from an accounting perspective, there is a 3-tier process in initial recording of the transaction, subsequent measurement for the balance, and then there should be disclosure of that balance. Okay, now we get into a little bit more meaty topics when we're looking at the inventory cycle and the finance and investment cycle. So let's do inventory first.